Equities. I've used the word a few times. It's what we call the market in shares. So it's what goes on in the stock markets, what companies are doing. And that's what I'm talking about for the first half today. And the second half, I'm going to talk about bonds, the bond market. So bonds are the instrument by which debt is conveyed. Con talked about that. Governments issue bonds and companies issue bonds. And then this afternoon, I'm going to talk about commodities and foreign exchange. This is just to set the scene. There are a couple of other asset classes that I'm not going to mention. Property, you can invest in property. You can invest in property through funds, but equally you can put your money into buildings. Americans tend to call it real estate, and in Britain we tend to just use the word property, but it's the same thing. And of course cash. Cash is an asset class. And any fund, any kind of general kind of fund, will usually keep a little bit of its money in cash. Con's also covered this a bit, but just whenever you're working as a journalist, you've really got to bear in mind who your readers are. Who's reading this stuff that you're writing? I keep forgetting I can walk around. I was thinking this was plugged in somewhere. Con talked about consumers, but the consumer market, sometimes professionally they talk about the media market, media clients. So that's kind of newspapers, it's radio and TV. And then out there are a whole bunch of professionals. And when you work for a wire service, as I've done, you're sort of focused, well, actually, you're focused on all of these people. But you're always bearing in mind that you've got professionals out there. You've got traders and analysts and fund managers who are reading your stories. And then you've got the actual consumers who are getting the news straight from you. Reuters, the wire services, to a greater or lesser degree, put some of their material on the web. You can look at it for free. Reuters and Bloomberg especially, there's a fantastic amount of stuff. Prices are delayed by 15 minutes, but you've got it's a great resource. And I'll look at some of those sites, I hope, later on. Okay, I hope we're going to talk a lot about how the market works. Share prices go up and down, indexes go up and down. But in the end, you've really got to add value as a journalist. Any idiot can look at the website of the Ukraine Stock Exchange or the London Stock Exchange and see that which prices are up and which prices are down. But what you've got to do as journalists is add value. Now, I'm guessing that in the first part of this course, you talked about some basic journalistic principles. Did you have who, what, where, when, why, how? Yeah, so you're answering those questions, really. And so what your readers are going to want to know is the answers to those questions. They don't just want you to tell them that the stock exchange index went up today because this share was up and that share was down. They want to know why. What is it that's made those investors buy that stock and sell another stock? They want comparisons. If the Ukraine market is up, is that just in line with what's going on in the wider world? In which case maybe it's less special. But if one market is up and the rest of the world is down, well, that's interesting, and that's another question you've got to answer. And within a country, I mean, Ukraine Stock Exchange only has 10 companies. It doesn't have sectors. But bigger stock exchange, they divide the companies into sectors. The financial sector, that's banks and insurance, technology companies, media companies, telecoms companies, mining companies, all of that, so different sectors. So within the UK, if one sector is up, is it up in line with the whole market, or is one sector up and one sector down? And then look at answering the question why. So that's just another kind of comparison. If a company has announced its results might be 5% better than last time, but was that expected? You may have spotted that in most developed markets, there are thousands of analysts whose job it is to predict what companies' results are going to be in advance. And Reuters and Bloomberg call up those analysts, and those results of those forecasts from those analysts produce what's called a consensus. So in the days before, Vodafone releases its results, there will be a forecast for what that profit figure will be. So we don't just want to know, is the profit up, but is it better or worse than forecast? The share price will react today following the forecast. If the forecast is positive, the share price may go up today. If the forecast is negative, the share price may go down. It's a bit of an old picture, but this scene still exists today in Chicago. People in different colored jackets trading on a market. And this is a system called open outcry. And it means that deals are done by two people talking to each other, or sometimes using hand signals. There is actually an official range of hand signals for these deals. Mostly the trading has moved on to electronic trading. There's virtually none of this left in London. This is still going on in Chicago, but it's not the whole of the commodities market. Okay, let's talk about the equity market. Globally, this is $63 trillion of trading a year. It's smaller in that sense than the foreign exchange market. Foreign exchange market is the biggest. That's trading $4 trillion in a day. Market capitalization. We'll come across this term a bit later. Market capitalization means the total value today of all of the shares issued by one company. And if you're talking about a whole market, you can add the market capitalization of all of the companies on that market, and then you can add together the market capitalization of all the world's markets, and that's the figure that you get, $57 trillion. And that's shares issued. And the trading, these are some of the exchanges. But in Europe especially, there are loads of electronic systems on which people trade shares. And in the equity market, it's completely transparent. You can't see it on the internet, but if you're a Reuters subscriber or Bloomberg, you can see the price of Vodafone stock on a whole bunch of different marketplaces. And people can arbitrage. People can look at the price on one exchange and see if it's a slightly better deal than the price on a different exchange. So that's the overall market. I've got some slides here about the Ukraine Stock Exchange. This is one day last week, but this will be the same picture with any kind of international exchange. So where should we start? It's an index. An index is a figure that represents the share prices of all the companies in that index at any given time. So it's going to go up and down in real time. It's going to go up and down as people buy and sell shares, as the prices of individual shares change, and then at the end of the day, there's a closing price. 864.5 was the closing price the day before I did this. This was the closing price on that day. So we have a difference in points. It's gone up by 10.9 points, and that's 1.26%. So on that day, the index was up that much, and that means that was the percentage by which the overall market changed. That's the basis for reporting on that market. Was the index up? Was it down? And then you want to know why. And this little chart here, which is really useful, tells you why. I suppose it's obvious. This company, this is the influence on the index. So this company has gone up. This is Centrenigo. It's gone up by that number of points. So it's had the biggest influence. What's the next question you want to answer as a journalist? Why? Absolutely. Well, I clicked on the company. We'll try this in real time now, but because it's mid-morning, there may not be any story. And I picked this day at random. So I clicked on the company, and then I got the news. I can use this, sorry. That's the plot of the share price of that company on the day. And then on the same date, there's a news story. So I was worried you couldn't read it, so I put it there. So you guys better tell me, because of course it's in Ukrainian and it doesn't. So this is net profit, is it? So we've answered the question. I was hoping it would be a story like that. It could have been something rather insignificant, and then I would have looked silly. Okay, so it's got its half-year results, you said. Was that right? Yeah, so in the first half, its profit went up 2.4%. And the other important, I'll go back to that last one. The other important bit of background is what's called the free float. How can you privatize a company that's already quoted on the stock exchange? That's not, in the West, that's not logical. It's already private. Except the free float. Now, the free float means the percentage of the stock in a company which is actually available to be traded. And I'm guessing that the system in Ukraine is that the government holds big shares and some oligarchs hold some big shares in these companies. And they just allow a small percentage to be floated. Investors don't, in the West, investors don't like this situation. As an investor, you hope that you and all the other investors have a sort of common interest and you can influence the company. If this is less than 50%, even if everybody got together, which is sort of illegal because it's conspiring, but still, you couldn't change anything about the company, could you? Because you haven't got enough of the shares to control it. In Britain, there's a legal minimum of free float, which is 25%. So none of these companies would comply. Now, it does happen. This sort of thing does happen in Europe and certainly in America. Did anybody look at the flotation of Facebook 2 years ago? Mr. Zuckerberg, Mark Zuckerberg, created Facebook, but it was floated on NASDAQ. I can't remember the exact figure, but the free float on the day it floated was much less than 50%. I think it was something like 25%, which means that he's asking the shareholders to buy into Mark Zuckerberg, if you like. He's controlling 75% of the company, he and his friends. I mean, it's changed now, and I think it's now more than 50%. He's released more shares. But the similar situation arises in France. There are, L'Oréal. L'Oréal is the cosmetics company. It's floated. You can buy shares in it, but it's much less than 50% free float because there's an old family, an old French family, which just carries on controlling it. And if you're an investor, you know that. This is a spreadsheet on the stock exchange website, by the way. I just downloaded it off the website of the stock exchange. Going back to the previous slide, this is also obviously on the website. It just tells you what's going on a particular day in a lot more detail. I just want to mention market cap. I said earlier the total market cap of all the exchanges in all the world was $57 trillion, I think. So this is the market capitalization of the individual companies, which you can put in order, obviously. Yeah. So, and then you can see their effect on the index. So this is the figure that we use to talk about the size of a company, really. And in Britain, the biggest market cap is HSBC, the bank. And I think Vodafone might be number 2, and then Shell and BP, the oil companies, are up there in the top 5 as well. And of course, it changes from day to day, because it's the value today of all the shares. The number of shares is not there, but there is a number of shares at issue, meaning out there. And you multiply that by the price today. Where's the close? Well, we don't have the close, but the last trade. Actually, this is a good time to talk about bid and ask. How the market works is that if you own the shares, and you're interested in selling, then you ask for a price. And if you're interested in buying, then you're bidding, so you offer a lower price. And the difference between these two is called the spread. Quite a small spread. It's the same in any market, but quite a small spread. And normally, at one of those prices or somewhere in between, a deal is done. So every deal is done on the basis of bid and ask. Okay, this is a similar chart from the London market. I just took the top 12 by market capitalization. I can tell you what website this is from if anybody's interested. You can't actually do this on the website of the stock exchange or Reuters, but you can. There's a different one. HSBC, Vodafone, BP, oil companies, tobacco is there. SAB Miller, anybody know what they do? Beer. Oh, you know it, good. Yeah, most of my students in England don't know that. Well done. Diageo? Yeah. Johnny Walker, absolutely, well done. Lloyd's, another bank. Rio Tinto is mining. There's an interesting thing here about what a stock exchange index tells you. In Ukraine, it's telling you something about the Ukraine economy. Even if, the free float is a bit low, you can use it as a sort of benchmark of the economy. And in a way, that's how traditionally the media in Britain have looked on the FTSE 100. But actually, some of the companies in the FTSE 100 have nothing to do with Britain. We have 2 mining companies from Kazakhstan. We have Russian companies. We have Australian companies, who have almost... In London? Which one? Is that in the 100? No. Okay, but still, it's the same issue really. But these are meant to be the 100 biggest companies in the UK, but a lot of them don't have anything to do with the UK economy. And so, the media generally, certainly the BBC, are sort of scratching their heads and saying, how should we deal with this problem? And they haven't really come up with an answer. One answer is to report on the FTSE 250. And that's the 250 next biggest companies in order of market capitalization. Because most of them, maybe Ferrexpo is in that group, but most of them are actually genuine UK companies. But this is an issue for journalists, really. You're reporting on a market, but what are you telling your readers exactly? So often, when you report on this market, you have to point out that it's not a very good benchmark for what's going on in the UK economy. It's good to bear in mind who owns the shares. Con talked quite a lot about institutional investors, and they are obviously the bigger players. These figures are a bit old, but this is an important figure. Individual investors are only owning 10% of the UK market. This figure is not very useful. It just says foreign investors, but it tells you, that that's where the money is. You probably know one of the reasons why London is such an important centre is because we have huge numbers of foreign banks, huge amounts of foreign money sitting in London looking for good investment vehicles, and that's why Ukrainian, Kazakh, Russian companies, Australian companies list on the London market. And Ukrainian companies go to Warsaw as well, don't they, to list? I guess because there is a source of funds there. These kinds of investors are sitting in Warsaw looking for good places to put their money. And that resource, that pool of liquidity is not available in Kiev, I assume. So again, as a journalist, you have to kind of bear in mind who's owning the shares. I talked a little bit about the markets. Actually, what's going on out there in the equity markets in the last 2 or 3 years, a massive revolution. It's not been written about very much. High-frequency trading. Computer programs created by guys called quants, quantitative analysts. And they write these programs and they look for tiny movements in prices. It's nothing to do with the fundamentals. They're just looking for tiny movements in a price or a difference in on one platform than compared with another, because there are different trading platforms. And they're buying in quite small quantities, but they're doing millions of trades a day. Each trade is quite small, but they're doing huge amounts. And that's called high-frequency trading. Anybody guess how long the average time a share is held in London between buying and selling? This is in seconds, yeah. 2 seconds. 2 seconds. This figure is not so high in London. That's the New York Stock Exchange figure, but still. And this is, okay, these people are trading on tiny margins, as I say. But, you know, at some point this is going to have an influence on the market. And indeed, I don't know if somebody else will go into this in detail, but in 2010, on one afternoon, the Dow Jones suddenly fell 9%. They called it the flash crash. So was anybody around looking at the market then? You know, nobody understood why. Huge amounts of work went into understanding why. The New York Stock Exchange has put into place what it calls circuit breakers, systems that should stop this happening. But probably it was to do with high-frequency trading. It was a computer that somehow saw a movement or misunderstood a movement and put in some sell orders, and then more sell orders were created. You know, one fall generates another fall. Another computer says, "Oh my God, the market's falling, I must sell," and that's what happens. They say they've put measures in place to stop that happening again, but we'll see. Okay, I've got a couple of slides that are just to do with vocabulary. Americans tend to prefer the word earnings, whereas in Britain we tend to use the word profit. So we saw that slide center and ago. Its net profit was up 2.4%. In the US, they sort of talk about the word earnings. And indeed, they talk about, for journalists, they talk about the earnings period, because the frequency with which companies, not the frequency, the number of companies reporting their earnings on any one day is not constant. And there are periods when lots of companies report, and there are periods when not many companies are reporting. So if you're covering the New York Stock Exchange, the earnings period is your period of peak, being busy, basically. Sales is another word for revenue. I've got another slide coming up which kind of gives you the basics of a company's profit and loss. And you'll see the sales is the top line, profit is the bottom line, basically. I mentioned consensus before, that's the analysts. Guidance, I think I mentioned before that companies tend to hint to the analysts what their results are going to be. That's called guidance. And a profit warning is, to be listed on a stock exchange, and Ukraine is no exception, there are lots of rules that a company has to abide by. And it's all to do with fairness and transparency. And one of the things a company is obliged to do is to tell the market if its results are not going to be as good as expected. And that's called a profit warning. And that there's no kind of exact definition of a profit warning. And I've been in a situation at Reuters where we said company X issued a profit warning, and they've rung up and said, no, that wasn't a profit warning. And we have to say, well, on our definition, that was a profit warning because you said the results were not going to be very good next week. And of course, normally the share price will be affected by that. Moving on to the kind of news that companies report. Mergers and acquisitions, well, the big one today that I mentioned, Publicis and Omnicom. US market hasn't opened yet, but we can, actually, we could look and see what's happened to the share prices. Sorry, I'm going to break off if you don't mind, and just look at to see what's happened to the share price of Publicis, because while the US market hasn't opened yet, the Publicis Group, that must be it. The French market is opened. Okay, so the shares, this is the company that's going to merge with Omnicom. And if you're one of the reporters in Paris covering this story, one of the factors you're going to be mentioning is share price is up. So the market likes that deal. It could have gone the other way. I was discussing with Chuck over lunch mergers and acquisitions. Academics analyze mergers, and usually they conclude that the big mergers destroy value, meaning they're a bad deal. That over time, they actually don't create better profits. And who knows yet whether this is, whether this is happening. But at the moment, the market likes that deal, and we'll see whether the market likes it. The American market likes it from the point of view of Omnicom. Now I've got to find a resume slideshow. Does that get me back to where we were? Good. Yeah, so the kind of news that comes out. Personnel changes. This guy was chief executive of BP 3 years ago. Anyone know his name? His name's Tony Hayward. He was the head of BP when the oil well exploded in the Gulf of Mexico. And he made some comments that were not very kind of sympathetic to the shrimp farmers of Louisiana and all of that. And so they had to get rid of him. Big story, obviously, for investors in BP. Companies issue results. That was what happened last week with Centrenego. Trading statements. We're going to focus on that now. I use trading statements in these classes because they're the simplest kind of statement that a company issues. And then, of course, executives make speeches, and that's kind of useful. This is a simplification of a profit and loss statement. We saw before sales, revenue, it's the same thing. It's the top line. If you're making these marker pens, you're a factory making marker pens, and you sell them at $1 and you sell 100 in a year, your sales are $100. That doesn't take any account of the cost of buying the plastic and the ink. It doesn't take any account. It doesn't tell us what your profit is. But if we take off, this is a minus sign, by the way, if you're trying to follow this. We can find the gross profit by taking the cost of sales from the sales. So if I spent 50 cents on the materials and direct costs, then my gross profit is, and I sold 100 of them, my gross profit is $50. But that doesn't take account of overheads. Overheads means the cost of my premises, cost of basically running the business. As a journalist, you generally won't be reporting the gross profit. You might report the operating profit, because the operating profit is giving the investor a sort of basic idea of how the company is functioning. And that's sometimes called EBIT, earnings before interest and taxes. So that's operating profit. You might report that as a journalist. I should, by the way, say Bloomberg's rule, as I understand, is always to report the net profit. But we'll get to that. Okay, so that's the operating profit. But actually, you will have some other costs, one-off items. That means exceptional items. exceptional items can be positive or negative. If you're running a company and you have to get rid of staff, you will have to pay those staff. That's redundancy payments. So that's a negative. But if you sold a subsidiary, say I've got a factory making these, but I have a subsidiary that makes ball pens and I sell it, that's a plus. It's a one-off item because I can only sell it once. It doesn't tell the investor anything about my ongoing business. But still, some analysts will look at the pre-tax profit of a business. But as I say, Bloomberg, and in many cases, people will look at the net profit. And when we looked at that Centrinego last week, that was the net profit. So that's known as the bottom line. This is the top line, sales, the bottom line. That's a sort of colloquial way of looking at it. So it's this figure minus the tax. It's what's left. And then what happens? The company's got a net profit. What happens to the net profit? Oops, the answer's there. What happens to the net profit? So it goes two ways, doesn't it? Somebody tell me. Yeah, exactly. Some is retained for investment or for expansion, and some is given to the shareholders as a dividend. And yeah, as an investor, you hope to gain over time in two ways. One is from the dividend, and one is, you hope that the share price will rise. Okay, this is quite complicated. I'm not going to dwell on this any further, but I am going to go back. I should say a balance sheet. So this is the profit and loss statement, or sometimes called the earnings, or sometimes called the results. A company will also issue a balance sheet. Now, as a journalist in day-to-day reporting, I've never needed to look at the balance sheet. If you're investigating what's happening to their debt, to their assets, then that's a place to look. Okay. I mentioned just before that a trading statement was kind of the simplest of statements that a company issues. And this is an example from actually from last year. It's usually just a few lines. I mentioned it's the sales, but actually it doesn't have a figure in millions of pounds or dollars. What a company does is, in the days after the end of the quarter, it simply looks at the books and looks at where the sales are compared to the same period last year. Comparisons are always with the same period last year. So here, a quarter is not always 13 weeks. Here it's 12 weeks up to the end of that date in July. And they will compare that the sales figure with the sales in the same period the year before. And this is one of the figures we're looking for. This is the key bit of news, if you like. Total sales up 2%. But more important, like-for-like sales. I'll explain the difference. Oh, by the way, this term, in America, they use the term same-store sales. So if you look at Walmart's results, you'll see same-store sales. This is the one the market prefers. And the reason I said at the beginning we want comparisons that are comparing like with like. What the company has done here, and this is standard for any company in the retail sector, is to look at their sales as they would have been with the same number of stores that were open a year ago. Because the company is expanding, I think in this case they may have been contracting, but typically a retail company is expanding, it's opening more stores, it's natural it's going to sell more stuff. In this case they sell iPads and computers and televisions. But we want to know what the business would have been without that expansion or contraction. So that's why we look at like for like. Yeah, and that's the key thing. The company will normally add a few bits of information, but often this will be old information. If they say, we opened 7 new stores, that won't be news, will it? This is a quarterly statement. If they opened new stores, you probably knew at the time if you're the journalist who covers that. So you have to sort of be careful in these trading statements. This is the news. And because they're an international company, they've also put a separate UK figure in there as well. Yes? Now that's what I was just explaining. Like for like means they take the stores that they had open a year ago and they say what the sales were today in those stores, just those stores. So they exclude any new stores. Or in this case, it may have been a reduction in stores, but still, and that way the market can see, what the business would have been if it had stayed at the same size and not expanded or contracted. And that's the more useful figure. And as I say, in America, they use the term same-store sales. It's sort of more descriptive. There are 2 main ways that companies fund themselves. We've just been talking about the stock market. Companies issue shares. That brings in the money that a company needs for its investment. They can also issue debt. And Con talked about this also this morning. And that debt takes the form of bonds. The main distinction is that shares are, well, there are lots of distinctions, but in terms of trading, the main distinction is that the shares are traded on regulated markets. Every stock exchange, a government or some kind of regulator is insisting on complete transparency for all investors. Bonds, it's a whole different kind of market. It's called over-the-counter, which means it's effectively a deal between the buyer and the seller. Now, there's a broker there, but the broker is not required to report publicly what's on offer, what's going on with that trade. So in that way, it's a very different kind of market to report on. You can report on new issues, and there may be lots of new issues, or one week or next week there may be not many new issues because the market is not very active. But you have to look for kind of themes, and you have to look for yield. Yield is the amount that somebody who buys a bond is earning on that issue. So there are lots of different bonds. They generally are held for longer. Certainly longer than the 2 seconds, which is the average for a share. They're less liquid, meaning that each bond might be quite small, not much trading going on. It's not a big open market, and the sizes of deals are bigger. You have far fewer ordinary people holding bonds. Con talked this morning about mutual funds. Ordinary people might, in America especially, might invest in a mutual fund, and that mutual fund might hold bonds as part of a portfolio. But ordinary people don't tend to buy these. I talked about companies. Governments also issue bonds. Works roughly in the same way. There's a primary market and a secondary market in any bond. The primary market means the initial issue of any bond, whether it's government or a company. And a company says, we need to borrow $50 million, we're going to pay this rate of interest, these are the terms, and then the market will come and will buy them. That's the primary market. If you buy a bond in that market, you can hold it for the whole duration, say it's 5 years, or you can sell it tomorrow, and that sale, that then becomes the secondary market, what goes on afterwards. The important thing about bonds when you're reporting them is that prices and yields move in opposite directions. It's a very very difficult concept to get a hold of. I'm going to try and explain how that works. Is it the next slide? Yes, it is. Taking an example of a bond, I just made this up. This company wants to borrow $100 million. It's offering 5% over 5 years. The price is based on 100, i.e. 100%. Let's assume that on the primary market the price is 100%. That's the logic. Meaning, if you lend the company $10 million, well, let's say $1 million, you pay $1 million because that's the price. It's par. That's called par. That's priced at 100. That price can change on the secondary market, but we'll come to that. So if I buy $100 million of these bonds when they're issued, I'm lending $100 million to this company, XXX Corp. And that's the primary market. And in return, I'm going to get interest of, I hope I worked this out right, £50,000 a year. This figure never changes. For the 5 years of that bond, this company has to pay $50,000. In fact, they pay it in 2 bits of $25,000 for the lifetime of the bond. And so if I did that on day one, that's what I've got. And then I get my money back at the end. That's the primary market. And I could buy that bond, I could lend that money to the company and hold it. But in the secondary market, that's where this issue of price and yield moving in opposite directions matters. It means that when you're reporting on this market, you have to make clear whether you're talking about the price or the yield. Because you can't just say bonds were up, because you might be talking about the price or the yield. And both of them are important. So this bond can then be traded. What it's worth on the secondary market is largely to do with sentiment. You know, what do the investors, possible investors, think about that company? And a lot of that is to do with risk. Has the risk of that company defaulting means not paying back the 100 million at the end of the 5 years, if it was in trouble, has that risk increased? If that risk has increased, the value of that bond to me as an investor may have gone down. So the price I'm prepared to pay would go down. And in return, I will get a higher yield. So let's say the price, let's look at it the other way around. Sentiment towards the company has gone up. The price may go from 100 on the first slide to 101, theoretically, because sentiment has improved. The yield goes down because it's a relationship with this interest of $50,000, which never changes. It's a calculation based on that price, the relationship between that price, because for every $1 million worth of bonds, I've paid more than $1 million. So the value of that interest payment has gone down because I've had to pay more in order to qualify for this. And that means that the yield has gone down. It's a complicated area. If you want to look it up on ImpactMedia, there's a whole section on why price and yield moves in opposite directions. Generally, people report on the price. You know, the price of US Treasuries changed this much. But we're also very interested in the yield. And the yield is important because companies typically won't just issue one bond and then not issue any more. They will often have a number of bonds with different durations and different terms. And then in 5 years' time, when this bond expires, they have to give that 100 million back. They will issue another bond. So it's a constant process. And it's the same with governments. Governments are constantly borrowing new sources of money to replace expiring bonds. And this yield in the secondary market has an influence on the interest that the company has to pay on its new bonds, on its future bonds. What's important in government bond markets is to compare yields one country with another. Particularly in the Eurozone, until Greece's troubles, all of the, I think, is that the next slide? No. All of the yields of all of the countries in the Eurozone, when the Euro was created, they all kind of came together for a number of years. If it was euros, it didn't kind of matter so much that they were different countries. People thought, oh, well, it's the euro, the yield is the same, the bonds are the same, the risk of default is the same. We've now learned that that's not the case. But the market prices bonds in relation to a benchmark. The US Treasury bond is often a benchmark. Here, we've got the spread against US Treasuries, 10 years. The US government will issue lots of 10-year bonds. The market takes one as a benchmark, and we can compare the yield on different countries. This is just the top of a longer chart. So if you invest in Australia, if you buy Australian government bonds, your income, your yield, the money you get, will be that much more than if you bought American bonds or German bonds. Everyone gets a higher yield. Back to risk. The risk of any of these countries defaulting, particularly Greece, is higher than the risk of Germany defaulting. So it's all about risk. So the prices are lower. So that's the difference between Germany. The German yield is 1.68%. And so if you buy French bonds, you're going to, as an investor, because the risk is greater, you're expecting a bit more yield, so something like 2.3%. And that's how the market looks at the government bond market. And of course, this will fluctuate over time. This is changing daily as sentiment changes, as governments, as the economy changes, as any bit of information comes out about one of these countries, sentiment out there in the market changes. So this is the job I used to do in London, reporting on these changes a long time ago, admittedly. I didn't mention it in the example, but this, when the company issues the bond, this is called the coupon. That's the market term for the interest rate on the underlying bond. When it changes, it's known as the yield. It's actually yield to maturity. It's this calculation of what it's actually worth. But it's called the coupon because originally, when you bought a bond, I think this is actually a share certificate, but it's the same idea. You tore a little piece off, took it to the cashier, and qualified for your interest payment every 6 months. And it was physically a coupon. Now, of course, everything's electronic. I've mentioned risk a lot. The way, I don't know, are there any rating agencies operating in Ukraine? It's a domestic rating agency, is it? Yeah. Yeah. Yes, if Ukraine was issuing a bond and hoping to get international investors, then it would need a rating from one or more of these agencies. Some countries do have quite big domestic agencies as well, but this is effectively what you need to use if you're hoping to attract international investors. And if they're issuing bonds in dollars, the implication is they want some foreign investors, I guess. So this is the rating scale. what makes life complicated is that they're different, but they all start with AAA. So AAA is the best rating, which the US, of course, lost 2 years ago. I think Britain still has AAA. Some other countries have lost it. Yeah, so the rating agencies basically look at the terms, look at the issuer, and they issue a rating. Anything above here is investment grade. This chart doesn't actually say that. Investment grade, this is non-investment grade, sometimes called high yield. Now, high yield sounds positive, doesn't it? Which it is. You're going to get a lot of money back. If you invest in bonds with these ratings, like Greece, Greece is junk, you're going to get a relatively good yield back, because in return for taking that risk, you will be rewarded. And that's what the rating agencies are doing, really. They're helping the investor quantify the risk. And if you go to their website, you can see a paragraph of definition for each of these. And it really talks about the risk of default. You know, what is the risk of that issuer not repaying the principal at the end of the 5 years or whatever it is. I think this is up to date. Is there a date on here? This is from Reuters. Actually, this is from December, so it may be out of date. So that's right. USA lost its AAA rating from S&P, but it still has AAA from Moody's and Fitch. Japan up there, low risk. These are the European countries with AAA. And then, where's the UK? UK's fallen off that chart, hasn't it? Don't know why that is. I think UK is still AAA for all three. Yeah, so that gives you, that's the picture really. If we go back to the previous chart to see what's junk, well, if we just take Fitch, anything less than BB plus, Fitch. Yeah, so that's in. What's that? Yeah. Yeah, so those are regarded as non-investment grade or junk. Yeah, so those agencies are analyzing the risk of default. I did want to talk briefly about ethics. Yeah, this was one case where a couple of journalists were punished for writing in the Daily Mirror. So I was going to mention books, some good books about the crisis, and this is the film that Con mentioned this morning. Fantastic film. This one is fiction, but it's about the crisis also, with Kevin Spacey and Jeremy Irons. Okay, thank you very much. We'll talk about commodities and Forex this afternoon.